Hello, everyone. Welcome to Weekly Tax Update for January 9th, 2026, our first event of the new year. My name is John Sheely, and thank you for joining us. So what's going on in the world this week with episode 108? That's me. If you need to find me, by all means, scan the QR code. It'll populate my information into your phone. Feel free to call, email, let us know if we can help or if you need anything. First bit of breaking news is business returns will be able to be eligible for e-file beginning on the 13th of January, 2026. That's been out for about a week. We've known that, but by all means, you now have that date. Certain returns, though, are not going to be eligible until the 18th. Form 1042, the new 709 e-file will not be available until then, but 1041 won't be available until then. Otherwise, your other business returns, your partnerships, your S corps, things you've been holding on to, get them out the door. Now, this showed up as fake news a couple of times, and a couple of nights ago, someone sent me a text that could have been from the IRS website, but we couldn't find it anywhere to verify it, saying that e-file for 1040s for individuals would open up on the 27th. That was circulating around on social media. But yesterday, middle of a presentation I did in Michigan, I put up the fake, what I thought could be fake, and said, listen, this could be fake news, da-da-da-da-da. But now we do have positive confirmation. Came in the middle of the day yesterday. Stakeholder liaisons have emails out confirming it, that in fact, January 26th will be the first day. If all the forms are in fact available, I must say that is a record turnaround for the service, that they can get something this big turned around that quickly. It would be interesting. We're getting closer and closer to year-round e-file like California. It would be super interesting if they were able to do this now every year, cut it off Christmas time and reinstate it within a month. Certainly helps us for planning. I've talked about this twice before. I want to add it again as the tax season starts. Previously, the Postal Service, you dropped something in a mailbox and you got the postmark usually that day. The service centers were, the processing centers were closer to home. Now due to decreased mail volume and looking for cost savings, your mail is going to a further place to be processed. Here, we used to have a service center 16 miles away at Stewart Airport. And now, depending where you're mailing something, it first goes to Albany, north, about 90 miles, or south, about 70 miles to White Plains. So I mail something to my mother. It's quicker to drive the half hour and hand it to her than wait up to 3 days for first class mail to get there. But now the postmark, we encountered this in the past, that occasionally the postmark would be, 1 a.m., right? And you'd argue with the IRS, go pull the postmark. You'll see that there's no way it was postmarked at 1 a.m. It must have gone to the box, the night before. But now it's going to not be postmarked at all at the local office if you drop it in a box. It's only going to go to the central facility. My aunt's a retired postmaster. She used to tell us back in my H&R Block days that when they opened that box, they gave people the benefit of the doubt in the morning on the day after a deadline, and they stamped all of them, hand-stamped them, hand-canceled them. These days, the only way to get a hand cancel is you're going to have to walk it in. Now, anything I mail to the service, we send certified mail, electronic return receipt requested. I recommend you send it electronic return receipt requested. That allows you to access the postmark access the certified mail information up to 7 years from the date you send it. And in fact, it's $2.30 cheaper than sending it with that little green return mail postcard, which actually doesn't mean anything. I stuck this in here. I shared it with another colleague, and I stuck it in who's hiring people and having some difficulty. So I want to share this with all of you, because this is what our colleagues are seeing and what potential job seekers are seeing. As I speak to folks about hiring individuals into their tax practice, people are having similar problems. Everyone has a remote worker these days because the workers want to work remotely, whether you want them to or not. And what we're finding is that they're comparing other rates of pay around the country. So if you're in an area where a rate of pay would be $50,000 or $60,000, they're saying, well, the top pay, if I went to this big LA firm or this big New York City firm, is $20,000 more. I might work for you for a $21,000 difference. You shake your head, I can't afford it. So these numbers are out there from one of the publications, I think the Accounting Today or Tax Pro Today. Now, the one thing I'll warn you is that these are average numbers. So if a whole lot of people are a little bit above or a little bit below, it's going to skew the numbers a bit. A more useful number to me, in addition to the high and the low, would have been the median. If you remember your elementary statistics from college, the median is when 50% of the universe of numbers is higher than that number and 50% is below, right? It's not the mean, which is the average. So it's the median, and that's probably the most useful number. But either way, if you look at a first-year senior, this is somebody with 3 to 5 years experience. If you're going to bring them on full-time, at larger firms, people that are promoted to senior, average salary $89,000. The average new hire, because again, we're stealing them away from one of our competitors, or they see that $5,000 difference, they're willing to jump ship for $5,000. There's about a $5,000 difference for first-year seniors. For first-year managers, there's a difference of about $11,000. Now, I'll tell you, when I went to work for Weiser, now currently a top 100 U.S. firm, top 10 New York firm, I made $120,000 my first year in 2004 when I was during a non-compete agreement. So now, granted, Sarbanes-Oxley had been out, and that was skewing some of the numbers in the accounting industry. Just like today, numbers are getting skewed. But just to put that in perspective, that 121 as an average number for a first-year promoted manager. Things to consider in whether you're hiring and the difference that you're seeing. I've talked about this before, so I'll be brief. If your EA number if your Social Security number ends in 4, 5, or 6, it's time to renew your enrolled agent status. You have until January 31st to renew. You need to have your CE done by last month, but you have until January 31st to renew, and then your current license expires March 31st. So you want to get those in as soon as you can. You don't want to get to not send it in before then, because they will move you to inactive status and you won't be able to represent taxpayers. I've updated the IRS processing times because it's the beginning of the year. My number one pet peeve right now is the delay in identity theft. Form 14039 for individuals is being processed ones submitted back in June of 2024, 19 months ago. Now, they did move that up quickly. In the last 3 weeks, since the last time we met, that number has moved 5 weeks down the cycle. I think that could be because in tax season, I don't know how many of these things get submitted. I think that some of these come out of either the IRS putting you into realizing that there was a fraudulent return filed before yours and moving you into the identity theft status, or we don't get this done until the return rejects. We tell them, I can't help you today with all of this. Go gather these records. Come see me April 16th. So I think some of these, there's probably a cyclical drop. I don't have any proof to back that up. I suspect it's a cyclical drop. They're not working any harder on this. There's just a 5-month jump because there was less to work on. Form 14039 moved ahead 2 months in the last 3 weeks. They're now working on August 2024 cases. Not much better, and a huge embarrassment to the federal government. So if you're an enrolled agent or a CPA or an attorney, and you would like to be a subject matter expert and help design the new enrolled agent exam, PSI, the new vendor who has replaced Prometric, PSI also does a whole bunch of other exams, including the Oregon licensed tax consultant exam for enrolled agents. When I took the PSI center, conveniently, it was located in the Prometric Center. In other words, these are The testing centers are even outside vendors, right? So you're probably going to go to the same place you went to. They're actively seeking qualified volunteers to serve as a subject matter expert. Now, when I did this for Prometric, you come on group calls, they show you some of the questions, and you help them design if they have bad questions. Sometimes they have the wrong year. Sometimes the answers and the question don't match. In other words, you say to them, do you know what they're testing for here? Because those answers could be right for a different year, for a different entity type, let's say, and the person on the other end of the call may not know, but they'll ask you to specifically tell them what you mean, and they'll write it down. So I do think that they take this seriously, and they're looking to get this done correctly. It's a paid gig, the last I remember. This says volunteer subject matter experts, but I seem to remember I got paid. So if you're interested in this, you might want to apply for it and just see what it's all about. I think I gave you the link in there. If the link isn't here, email me. I will send you the link. But why this matters, you're going to help influence the exam, help shape the future of our profession. The reason they use us is who better to tell them what the issues are and what the answers are than us as professionals. And contributing to this is going to help your professional development, maybe help you with how you understand our own industry and the work that we do and the code and regulations. Or the code anyway. So it's worth a look if this is something interesting to you, and you can put it on LinkedIn, right? That I was a subject matter expert. So the documentation suggests the literature that practicing professionals are an ideal candidate, and educators who understand these issues might also be good candidates. So I know a couple of instructors who teach EA classes, and I think that all of them should apply to help. As I understand it, you'll have these meetings. They'll be regularly scheduled, and you'll be asked to participate live in the Zoom call. They turn on the camera, turn on the microphone. There's a time commitment. You really can't share what goes on, but your input is going to directly affect what EAs need to demonstrate the tone, the rigor, and the accuracy of the exam. So please think seriously about this, and some of you should really think about doing this. I think you'd make a difference. Here's the link to access their recruitment survey. They call it a survey because it's really not a job application. I did not apply. I don't have the time. I don't think this year. It wouldn't be fair. But by all means, if you think this is interesting, why not fill out the survey? You can always say no later. If you can't make that link work in the handout, copy of this presentation is in the handout. If you can't make this work, by all means, email me, and or email Nicole, email Marvin, or Ellie at Tax Practice Pro. Any one of the four of us will get you the link. The 2026 standard mileage rates are out this week. I won't bore you reading them to you, but I will note that business use is up, medical purposes are down, military is down, charitable organizations are the same. As a reminder, charitable organizations are codified. The code says 14 cents without a provision to adjust for inflation. So maybe that's something we should mention to our leaders, our legislators, now that folks are going to itemize more. Internally, if you have mileage log templates or other worksheets, you should update it for 2026. We help clients with accountable plan reimbursements. We give them forms. Make sure they're updated to the 2026 rate. Put at the top for use during 2026 only. Make sure the staff knows these things. And where necessary, reach out to clients. I put here real estate developer professionals, folks that are going to take a deduction. What we really do is we get this out to our other clients who reimburse their employees and contractors to make sure they know what the current rate is. They can always pay less, but if you pay more than the IRS rate, it's supposed to generate taxable income. So we just make sure people know what rate they're supposed to do. As a reminder, the Affordable Care Act and the tax subsidies still expired, and nothing has been done yet in Congress. They expired January 1st. I have a peeve that the Congress and the media keep saying that we have now raised insurance premiums. Well, premiums are the same. They are what they are. We have made health insurance more costly by eliminating, hopefully temporarily, the advanced premium tax credit, because many folks don't wait till the end of the year to see if they qualify and how much they qualify for. They need that monthly advanced premium tax credit being paid to the insurance company to make their insurance more affordable or affordable at all. So Congress is back after the holiday recess, but there's a House vote scheduled. And what they did is they forced the vote through something what's called discharge petition. The House wasn't going to put it to a vote, House leadership, the Republican leadership, but 4 House Republicans signed on with all the Democrats and said, hey, we really got to vote on this, guys. And I believe that it's supposed to be a 3-year deal. I want to remind you, and I remind everybody I talk to about this, that when you pass a tax deduction or a tax credit, if you want to make it permanent, you're required to fully fund it, right? The Byrd rule. Can't run a deficit on something forever. So interestingly, the Affordable Care Act passed 20 new taxes. The individual shared responsibility credit, the tax on applicable large employers for not having insurance, for having employees that go on the exchange anyway. The NIT, the net investment income tax, that tax exists to fund the Affordable Care Act premium tax credits. The 0.9% Medicare tax exists to fund these credits. And there's a whole bunch others like the medical device credit, the 10% excise tax on tanning services, those of you that tan. So the only thing that went away is the first couple of days of the Trump administration, it might have been the first day, issued an executive order making the individual shared responsibility credit zero, that 2.5% of your AGI you were going to pay for not having health care. But all these other taxes are permanent. So it's interesting they are not stapled to the advanced premium tax credit because that's what they fund. And you'll notice no one is saying, well, this is a good thing that the premium tax credit went away because I'm going to pay less capital gains tax. In fact, most of my clients still think they pay a 20% tax, not 23.8. So I'll get off the soapbox now. Clients are going to expect a higher net premium these days. And we still have this risk during the reconciliation process that there's going to be a mismatch between the advanced credit and the final reconciliation at the end of the year when we look at the tax return. Still could have the wrong amounts. Clients will have to pay back, as we know. Probably in the working poor, those that are above the poverty limit, but subsistence livers, subsistence households. Early retirees that have a gap until they're eligible for Medicare have to pay for something. Those that do get a subsidy, this is going to harm the household, harm them. And then, of course, we've always said clients who have additional late income can be subject to the credit having had the wrong advanced premium tax credit all year. You might want to tag and identify your folks who have a marketplace policy and see what they're doing right now. Make sure they understand some of the challenges, things that are available to them. A lot of our clients, we always run a projection anywhere between 2 and 4 times a year. And one of the things we look at is how much advanced premium tax credit subsidy they're getting. Now, in most of my cases, I tell the business owners, don't take the advanced credit. Just get it in your refund at the end of the year. When we do the final projection, maybe we reduce the fourth quarter payment by what we think the premium tax credit will be. Here, both Tax Practice Pro and my accounting practice, we try not to talk about things in a political way. You've heard me say this. You see me put this on social media that everything we're doing is based on the law, right? Not I support this, I don't support that, or whether you support it or not. It's the law. We're going to help you. So you should think about the messaging that you want your staff to be sending out and make sure they're good with it and that they're following this so that you're not offending anyone. We have a new law that was passed, the Disaster-Related Extension of Deadlines Act, which is an interesting thing. So this was signed into law right after Christmas, and it's a legislative breakthrough that's going to protect taxpayer rights during disasters. There have been some problems, and this was actually a bipartisan measure like the Math Act and a couple of other things that it's like, okay, we all think it's a good idea that we should do this, and it was something that's been on the National Taxpayer Advocate Purple Book, her list, her report to Congress, and her list of things that I think you need to do this. Purple Book is items 56, recommendations 56 and 57 are what this law will provide for, and it elevates some of the advocacy into law, which again is great. Both sides supported this, which is why it was able to pass. And it guarantees that certain administrative procedures serve disaster victims rather than creating an additional burden. Let me show you what some of the burdens it was doing. We had this glitch because the IRS system didn't always get updated sufficiently enough or quickly enough. So previously you would get a collection notice and the threat of penalties even when there was disaster postponement in effect. How embarrassing. And of course we came to one of us, you take a power of attorney, you make a phone call, and the IRS is like, oh yeah, that is a disaster declaration area, isn't it? And the penalty, the notice goes away. But either you're doing that for free, and if you're in an area where a lot of your customers are covered by it, that can get expensive in terms of your time or your staff time, or you're charging people, and that's not fair to them. It's not my problem that's not fair, but it's not fair to them. So the number available in 2023, there were 1 million erroneous notices sent into disaster areas where they were supposed to suspend the notices. They sent 1 million of them. With 160 million taxpayers, that's an insane number to begin with, right? But 1 million erroneous notices because they were too soon or not appropriate. So the IRS tried to fix this with cover sheets, and you've seen these. By the way, if you're in a disaster area, right? But of course, these were contradictory. Here's a notice of intent to levy, pay now. Here's another one that says, you have more time because. Come on. So we spent all sorts of time explaining it to people. And in our practice, we made the phone call anyway, because I don't need emergencies, somebody who gets that notice of intent to levy or some other problem. So we always made the call to make sure. So the bill amends Section 6303. And this aligns the deadline for the issuance of the first notice, the CP14, that, hey, you owe me a tax bill. It's going to align it with the postponed disaster deadline. And I believe all the other notices are tied to the issuance of the first notice. So it wasn't a huge programming thing, right? To say, oh, by the way, go do a lookup of the zip code. And if that zip code is in a disaster area, pull down the associated date, and there you go. Don't send the notice to that date. But this is going to have a huge impact on people because the IRS won't issue, now they're concerned, erroneous notices that get wasteful phone calls, wasteful letters, certified mail letters. How many letters did we send during the shutdown because the notice machine kept running and you couldn't get anybody on the phone? So it's an elegant fix and it's comprehensive, and it really, you have to laugh and say, where was IRS management? Because it seems like a no-brainer for all the other updating they did associated with the various disaster declaration laws. Why didn't they do this? But now they have to. So we've had this trap with refunds and the statute of limitations. Disaster relief postponed filing deadlines, but it didn't extend it. We encountered that. We just did some research for someone that's in one of the coaching groups that they had a 21 return, which was due May 15th. And they thought, if you remember, a 2020 return was due in May 15th. That was the postponed date. And they thought they had until May 15th to file an amended return. They filed it before May 15th, but after April 15th, because they didn't want to do it during tax season. And what happened? The service correctly said this is a time-barred refund. Doing the research, you see postponed versus extended. If you didn't file an extension and merely relied on the May 15th date, you don't have that protection that you otherwise would have, which is silly because, so I'm going to file 100 extensions just in case. I don't know. So anyway, the deemed pay date for withholding and estimated tax payments wasn't May 15th. It was April 15th. That's when things are deemed due. So the 3-year refund statute of limitations looked back from the actual filing date of a return to the deemed period. But the disaster postponement wasn't included. There wasn't an adjustment that said we gave everybody extra time. Now, COVID, they only did 60 days the first year, 30 days the second year. But you have 90 or more days on some of these huge disasters, and a lot of taxes will get, postponed. So, of course, not extended, but postponed. So taxpayers who file within the postponement window might subsequently have a refund claim that gets denied because of the look back, looking back to 3 years from the original statutory due date, not the postponed due date. So you have to amend 7508, and you might know 7508 because we all have that joke that when the IRS Treasury extended the 2019 returns due April 15th, 2020 during COVID, they extended it or postponed it until July 15th. His initial postponement was via Twitter and the social media platform X, and that everyone was saying the joke. Is that legal? Is that all he needs to do? And yeah, he said so, therefore it is. So they're amending it, or modifying it, they say, to include the postponement period in the RSED, the Refund Statute of Limitations look-back calculation. This will ensure taxpayers who file within the disaster postponement window won't lose their rights to legitimate refunds by time barring them tied to the original due date. So this creates fairness. It's one of the tax code fair. It aligns, though, the disaster makes it internally consistent. It aligns disaster relief rules with the traditional filing extension rules. If you postponed it to this date, everything should go there, not just the initial filing of the return. All right, it eliminates mixed messages. It safeguards legitimate credits. I won't lose the right for refunds I'm legally entitled to receive, simply because of this procedural technicality that even some professionals missed. And then, of course, one of the things the Taxpayer First Act says that the tax code should be fair. So this is fairness. All right. So this does more than fix technical stuff. It's compassionate, but it's internally consistent. What's interesting is it shows what practitioner advocacy and bipartisan cooperation can do. I think the taxpayer advocate being behind this was a large push. This is also what they call a no-cost item to the government, pretty much. They're going to make one coding change, and that's it. And they like things they can do that don't cost money. I would be remiss in not mentioning cannabis rescheduling. I won't go, this isn't meant to be a class on taxation of cannabis, but those of you doing cannabis returns, there's an executive order from December 18th directing the Attorney General to complete federal rulemaking to move marijuana from Schedule 1. Schedule 1 under the Controlled Substances Act is the worst type of drug. It's highly addictive and has no medical use, even under a doctor's supervision. Schedule 3, you still need a prescription. It's still a whole bunch of dangers with it, but it has proven medical value under a doctor's care. So if we move it to Schedule 3, this will be a significant policy momentum, but the order itself doesn't say, I'm rescheduling marijuana. There has to be an administrative process. And why? There's rulemaking, there's regulations, there are a whole lot of things that need to be looked at. To me, I think the number one thing is, are they going to try and bifurcate marijuana into recreational and marijuana, recreational and medical? And I don't know how they'll do it. I think medical is going to go to Schedule 3 and recreational may not, which might create a lot more business for accountants. But what this is going to do is this will attack, hopefully, Section 280 Cap E, which is the one that says marijuana businesses don't get to deduct any expenses other than cost of goods sold, which is an adjustment to earned income. But as of today, we don't know what's going to happen. So we are assuming the 280E is still in place until there is a final rule. Maybe there'll be some transition there. We don't know. So the executive order directs the Department of Justice and the DEA to complete the Schedule 3 rulemaking. How are we going to do this? What are the new rules, etc.? They're going to expand medical marijuana and cannabis research. That's great because, again, it'll be legal, federally legal. It's going to push for policy attention around hemp and CBD product standards because they've had issues with pushing the limit on THC. CBD is completely legal. Hemp is completely legal, but you have to be under that 0.03%. And they talk about a Medicare pilot program. We'll see what they do with that, where that goes. So the executive order does not legalize recreational marijuana at the federal level. It does not instantly fix banking and financial services. Like right now, these businesses are still cash-based businesses. They're still federally illegal. They aren't all cash-based, but most of them are. And it doesn't provide 280E relief. But let's see what happens during the rulemaking process. Once they put up the initial rule, you'll probably have the ability to comment for 60 days. As we know, as professionals, when you, at a minimum, if you go look at the 3115 rules, they were changed from $500 for de minimis safe harbor to $2,500 based on all of us complaining. Politically, why is this still hanging out there? President Biden, former President Biden, had Health and Human Services he started the process. Health and Human Services made recommendations to the DEA, Department of Justice and the DEA. That was in 2023. DOJ and the DEA issued a notice of proposed rulemaking. They published them in May of 2024. And then it took until December. Probably they knew President Biden wasn't going to run for re-election. And they said, well, let's kick the can down the road. So it took almost a year into the current president's term for him to issue the executive order and move the can, pick up the can, move it down a little bit. So right now we don't know what's going to happen or when it's going to happen. I'm not going to review 280E under current law. If you need some help with that, let me know. We can help you. We can push people along. I can get you a meeting with folks. We said what's going to remain unchanged. There's still going to be federal-state conflicts. It's unclear if they're going to open up banking, insurance, financial services, all of these things. I think it's going to open them up, just like the Farm Bill made a whole lot of people. The Farm Bill that defunded the ability of the Department of Justice to randomly go after marijuana businesses. That's a whole nother story. But once that happened, accounting firms, law firms, everybody jumped on the cannabis bandwagon. And I think that what you're going to see here is, a couple of the big banks, Chase, Wells Fargo, BOA, are going to finally say, yeah, here's a set of rules we're going to take, that type of business. And then everybody will jump in because if they're willing to do it, why can't I? So we're monitoring the final rule. If you have cannabis clients, you should too. We're looking for clients that we work with. We're going to do they're mostly C Corps, so they're paying tax quarterly. We're, doing a recalculation every quarter. So in those particular cases, we're running two models. We have a 280E model, and we have what if you were taxed like a pizzeria model. And what may happen is if in the second or third quarter, probably happen after June, but if in the third or fourth quarter we see some movement, we're going to go back to the deductions model and adjust. And maybe they don't have to make a fourth quarter payment because they'll have overpaid or something. We're watching it. You should too. This is something you should get paid for, is the extra work. Otherwise, tell them, listen, I'm not going to in December do a year's worth of work. So even after the relief, it's still going to remain, still going to have audit risk, still going to need the high level of documentation, but we're moving into the 21st century here. And this represents significant policy momentum. but we're still walking that careful line. So 4 takeaways from today. If you want to help out the PSI, the current provider or the new provider of the special enrollment exam for enrolled agents is looking for some of us to volunteer, I think it'll lead to paid gigs, but they're looking for help on committees to review questions and help mold the exam. 2026 mileage rates were announced. We still don't have the Affordable Care Act premium tax credits restored. And there's a final rule that we're awaiting for cannabis rescheduling. Thank you all for attending today. I hope you appreciate these weekly missives. If you need anything else, by all means, please feel free to reach out, and I'm happy to help any way we can.